My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I just want to make some money. My job is not just to entertain you, but to educate and teach you. So call me at 1-800-743-CBC or tweet me at Jim Cramer. When I tell you that the stock market doesn't reflect current conditions in the economy, there's two parts to that. Last night, I focused on the fact that the major averages are not representative of the broader economy, something that held true today with the Dow falling 85 points, S&P losing 0.44%, NASDAQ sinking 0.57% after the dollar skyrocketed, something we warned you about last night, because the Fed minutes sowed confusion about how much they'll keep helping the economy. See, a stronger dollar is not great, but more importantly, the incredible V-shaped rally in the stock market simply doesn't jive with reality in a world where we still have double-digit unemployment. Tonight, though, we need to talk about the other part of the sentence. The stock market doesn't reflect current conditions. Emphasis on the word current. Why? Because the market's actually a forecasting machine. It's a crystal ball, and it's supposed to be peering 6 to 9 months in the future. Maybe the economy's in rough shape right now, but let's say the averages don't reflect now. Let's say they reflect next February. So what are the odds the economy will be in much better condition by then? And because that's what some people would say stocks are saying. Yeah, that's the key question. And tonight, I want to go over some major obvious data points that you and I both know, because you follow the market, that could help guide us to the answer. All right, first, let's start with the most reliable data available, and that's the actual results that we just got from Walmart, Home Depot, Lowe's, and Target, the biggest retailers in America other than Amazon and Costco. Now, all four of these companies reported in the last 48 hours, and if you listen to their conference calls, well, you got a couple of really bedrock takeaways. For starters, when it comes to big box stores, the consumer's buying pretty much anything that's not nailed down. The standout category, anything home-related, because so many people are stuck working home remotely. Plus, it didn't hurt that there's nothing else to do. Shopping at these essential stores became essential for your sanity. Once they rolled out mask policies and convinced you won't get sick, well, people couldn't stay away. The other major takeaway, though, for the most part, and this is what made some people think nervous about today, for the most part, spending tailed off as we got further along in the quarter and the government stimulus ran out. In fact, only Target, which had the best numbers in the group, hence why its stock rallied $17 at 12%. Yet only Target made me feel like the boom continued beyond July. Only Target reassured me. The other issue, while the numbers were fantastic, I think there's a big catch. As Target's hard-charging CEO Brian Cornell pointed out, much of their gains came at the expense of other competitors. Which competitors? All right, well, they said they took $5 billion worth of sales from the rest of retail. But let's puzzle over this. Given that Costco, Amazon, Walmart, Home Depot, and Lowe's all had great numbers, we got to conclude that aside from these big box chains, Target's taking from everybody else. I say the sign of the times. The rest of the retail is going down the drain. So it's entirely possible to craft a negative scenario from these numbers. That's not tortured people. You could do that because their gain is everyone else's pain. And if Congress can't pass another stimulus package, even the big box chains right now could be running on fumes. Now, I love that these companies are thriving, but in terms of crafting and forecasts for the economy, look, it was a mixed blessing. Second data point. We have an incredible roaring bull market in all things commodity. Oil, yeah, that's true. Oil's going up. Natural gas, lumber, copper, you name it. Now, you can see it all. You can see it in the oil stocks, which are kind of hanging in there, even though I don't like them, although I do like Pioneer. You see it in miners like Freeport McMoran. I can't believe that would take Tech Resources. Now, I think crude could still go either way. Prices have been able to rise because OPEC's holding down production. But other commodities, they're all screaming that better times are indeed ahead. Score one for the recovery. Next up, the entire housing complex has been on fire for weeks. Now, that jives with today's terrific mortgage application numbers. Housing only accounts for 10% of the economy. So you might say, well, wait, come on. It's a pipe dream that can help us. But wait a second. We say that it punches well above its weight. I regard it as encouraging. Now, I think the housing boom's about more than low rates. I believe people are getting more optimistic about beating the pandemic in the not-too-distant future. But the counterpoint here is that a lot of folks are buying homes in the suburbs to get away from COVID hotspots in the cities. Still, you don't buy a house unless you're feeling optimistic. Otherwise, you just rent. Now, some people will say that all this is a bubble created by the multi-trillion-dollar stimulus package and the Federal Reserve printing money like crazy. I say, forget it. That doesn't work. Don't asterisk stuff. It doesn't help you. Congress and the Fed were doing what I call their jobs. They created conditions where some companies could thrive, but the companies that are truly thriving are the ones that worked for it. Apple, Microsoft, Amazon, Alphabet didn't get trillion-dollar-plus valuations. $2 trillion today in the case of Apple because of the Fed. And honestly, even after these moves, I can create a story which says that those stocks aren't that expensive. Of course, the other thing about the recent rally is what I mentioned last night. It is heavily weighted in favor of the tech stocks that Wall Street loves when the economy is stagnant. 5 tech companies now make up 25% of the S&P 500. That's hardly diversified. The strength in housing is very encouraging. The strength in tech, not so much. The most worrisome thing about this market, though, it's the continued weakness in the financials. They can't get out of their own way. They are so far away from their highs, it's incredible. Now, I would feel a heck of a lot better about the economy if the big banks were going up and the financial technology stocks were going down. I think the weakness in the banks is far more important than Apple hitting $2 trillion today, or the home builders rallying, or even commodities going higher, because it's about credit risk, and credit risk can really hurt the stock market. So let's put it all together. Is the market predicting a boom? It's possible, but there's one huge caveat. Whether we're talking about home buying or consumer spending, everything comes back to COVID-19. I'm going to give some positives here. See, if you believe Regeneron's new cocktail trial in partnership with Roche that was talked about this morning can cut down the death rate to much lower levels. If you believe that everyone will be vaccinated in 6 months because so many good companies are working on vaccines. If you think Congress will pass a second stimulus package to bail out the millions of people who've lost their jobs, not to mention all the small businesses in danger of going under until we get the vaccine, then yeah, we could be in for a boom. And it could be in great shape, that it being the economy, by next February. Me, I think it's a little more complicated than that. As I see it, the pandemic has caused some permanent changes in the economy. And if those changes aren't rolled back, you might not like where we're headed. Let me put it this way. If small business didn't exist, if all we had were Walmart, Amazon, Costco, Target, Home Depot, and Lowe's, if they were the only retailers that mattered, if we didn't have a huge travel and leisure and dining industry all supported by small business, then I would feel great about the future right now. But you see, small business is integral to our economic future. And right now, that's what's being eroded, if not being wiped out. That makes it a lot harder for me to be as optimistic as I'd like, because sooner or later, that pain will make its way into the market, most likely via the banks, which is what those stocks are telling about, which is why they're doing so poorly. The bottom line, yes, I think the economy is going to look better 6 months from now. But based on the action in the market, it's probably not going to be that great. I'll start believing in a V-shaped economic recovery the moment we get a V-shaped recovery in the bank stocks, but not before. Until then, the real boom will only come with a vaccine. Everything else is either artificial and about to run out of gas, or digital, which is good for the stock market, but very bad if you get obsoleted because of it.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.